Welcome back to the deep dive. If you've been watching crypto, stable coins like USDC, USDT, they've always sort of lived on other chains. Ethereum, Tron, Solana, right.
Right. They were tenants, essentially. Useful, sure, but built on someone else's foundation.
But things are really changing now, aren't they?
Oh, fundamentally, we're not just talking stablecoins as tokens anymore. This is, well, it's becoming an infrastructure arms race.
An arms race.
Yeah, the big players, Circle, Tether, even Stripe, now they're moving off those general purpose chains. They're building their own dedicated layer 1 blockchains.
So shifting from being tenants.
Exactly, to becoming the infrastructure landlords themselves. It's a massive pivot.
Okay, so that's our mission today then. Let's understand this move. It sounds incredibly expensive, technically risky. Why build your own L1?
Well, it seems they're aiming higher than just faster payments. The goal now is creating these enterprise-grade financial operating systems. Think bigger.
Right, so this deep dive is really about the plumbing, the foundations under the currency itself.
Precisely. And the sources we looked at show the competition isn't just about who has the biggest market cap anymore. It's getting technical.
Technical how?
It's about, the actual payment experience, guaranteeing serious liquidity for institutions, and maybe most importantly, hitting all the right notes on regulatory compliance.
Okay, let's unpack that. Building an L1 from scratch, that's got to be high-risk, high-reward territory.
Absolutely.
So the old model using public chains, it worked fine for the crypto-native crowd, right? Why didn't it scale up for, say, global finance?
Yeah, the real sticking point, it was control and enforcement. Public chains are generally permissionless. That's their strength. Decentralization, great security. But they weren't really optimized for super high-frequency payment clearing. And crucially, you couldn't easily enforce strict compliance rules right down at the base layer, not without fundamentally changing what they are.
So when you start hearing about potential U.S. stablecoin bills, like Genius, talking about full reserves, central bank reporting.
And like a landing in Europe.
Then the chain itself, the actual infrastructure, suddenly becomes incredibly important.
Exactly. If your goal is enabling serious global financial stuff, cross-border payments, on-chain credit, settling capital markets, you need programmability.
You mean programming the compliance in?
Kind of, yeah.
Yeah.
You need the ability to build compliance checks, KYC, AML, right into the chain's logic, maybe at the validator level.
Yeah.
Public chains just aren't built for that kind of selective enforcement.
So it sounds like the industry consensus is forming. Despite the huge hurdles, security, bootstrapping, a whole new ecosystem, the sheer cost.
Yeah, massive investment.
Building these dedicated L1s is becoming the way forward if you want to play ball with traditional finance and regulators.
It seems that way. And what's really interesting is the technical gymnastics involved. It's not just about being fast. It's building trust through technology.
Okay, let's look at the contenders. First up, Circle. They seem to be going all in on compliance with their EURC blockchain.
Right. Circle's EURC is positioned explicitly as that, the compliant OS for programmable money.
It's the blueprint, you'd say, for a compliance-first L1.
I think so.
Yeah.
And critically, it's EVM-compatible. That's a huge deal.
Why is that so important?
Because it means all the developers already building on Ethereum, they can basically copy-paste their applications onto EURC. It dramatically lowers the barrier to getting an ecosystem up and running.
Okay, clever. What about the nuts and bolts? How do they get speed and that institutional control?
Well, there's always a trade-off, right? EURC uses something called the Malachite consensus engine, but the key architectural choice is the consortium chain.
Consortium chain. What does that mean in practice?
Instead of potentially thousands of anonymous miners or validators like on Ethereum, EURC has a much smaller, tightly controlled group. Think 4 to 20 validators.
And these aren't just random nodes?
No. They're specified as regulated, geographically spread out, reputable financial institutions.
So they're consciously sacrificing maximum decentralization.
For maximum regulatory control, yeah. And for speed.
Yeah.
Blazing fast speed.
Which regulators probably prefer anyway?
Seems likely. And this structure lets them promise really fast transaction finality. We're talking sub-second, under 100 to 350 milliseconds.
Wow. Okay. That's essential for high-value finance.
Non-negotiable for that world, yeah.
So beyond the structure, Circle's big pitch is their existing compliance reputation.
Right.
U.S. registration, those big four audits.
Right. They leverage that hard-earned trust. But the really interesting tech feature for businesses is this optional privacy protection.
Optional privacy. How does that work?
Well, transaction amounts can be hidden, which businesses often need for confidentiality. But the wallet addresses, the crucial part for compliance checks, remain visible.
So privacy where needed for business, transparency where needed for regulators. That optionality must be attractive.
It's definitely a key selling point for enterprises.
Okay, let's talk money. Tokenomics. They're using USDC as the native gas token. That feels like a big shift.
It absolutely is. It tackles the volatility issue head-on.
How so?
EURC uses a fee system, kind of like Ethereum's EIP 1559, which makes fees more predictable. But the killer app here is that fees are paid in stable USDC, not a volatile crypto asset.
Right, so a big company doesn't need to hold, say, ETH just to pay transaction fees with all the accounting headaches and price risk that involve.
Exactly. They can just use the digital dollars they already understand and probably hold. It removes a massive barrier for corporate treasuries wanting to operate on-chain.
And they're not stopping at dollars, are they? Plans for EURC, even tokenized T-bills? USYC.
Yeah, and building a foreign exchange engine directly into the chain. Imagine 247 institutional-grade FX quoting systems built right in.
That sounds less like a payment network and more like a full-blown global financial hub being built.
That's the ambition.
Right.
But it's a long game. The private testnet is coming soon, public testnet later this year, fall 2024, but mainnet beta, not until 2026.
2026. Wow. Okay, that's a serious multi-year commitment.
Definitely an infrastructure play.
Okay, let's switch gears. The other giant, Tether. Their approach with stablechain, or stable. It sounds similar on the surface, right? Institutional, EVM-compatible L1.
On the surface, yes. But their strategy, almost the polar opposite of Circle's.
How so?
Tether seems to be doubling down on market dominance, profitability, maybe speed over the kind of deep compliance Circle is targeting. Stable puts USDT front and center. Their CEO, Paolo Arduino, wasn't exactly subtle about it either.
What did he say?
He basically called competitors chasing compliance, like ARC, moths to a flame. Pretty aggressive positioning.
Okay, yeah, that tells you something. And that aggression seems reflected in their key feature, the fees.
Right. Stable also uses its stablecoin, USDT, as native gas. But the big hook is zero-fee peer-to-peer transfers.
Zero fees for everything.
For P2P, yeah. That covers tiny retail payments all the way up to huge cross-border settlements. And they're moving fast testnets live. Phase 1 is apparently already out there with the USDT gas and the gas-free P2P.
Okay, wait. If they're offering free P2P payments and they're moving faster, why wouldn't every institution just choose Tether? There has to be a catch.
There is. It comes back to that core difference. Transparency and reserves.
The age-old Tether question.
Exactly. Circle's USDC is known for, being backed pretty much 100% by cash and short-term U.S. treasuries, regularly audited by top firms. It's conservative, inspires confidence, but
doesn't make much money for Circle itself, low margin?
Right. Tether, on the other hand.
Yeah.
Their reserves are, let's say, less transparent. And they hold a significant chunk in higher yield assets, which means potentially higher risk.
Okay, so that's the key insight. The higher returns from those riskier assets basically subsidize the zero-fee transfers.
That seems to be the strategy. It fuels their ability to undercut on price, offer those attractive features, and maintain that massive market share they have.
But it comes with regulatory question marks. It probably limits how quickly they can get into those really buttoned-up US and EU institutional markets that Circle is clearly aiming for.
Precisely. That's the fundamental trade-off institutional players are looking at. It's a stark choice.
So high margin, maybe riskier speedster versus the slow, steady, audited fortress.
That's a good way to put it. And yet, Tether's clearly got momentum. They pulled in a $28 million seed round. Some big names involved too. Bitfinex, Hack VC, and interestingly, Franklin Templeton.
Franklin Templeton, a legacy asset manager backing Tether's L1.
Yeah, shows that significant capital is still flowing their way, despite the reserve questions. They have serious backing.
Okay, this is fascinating. Now, the wild card, the intruder, Stripe. Fintech giant Stripe is building an L1 called Tempo. What's the significance here? They're not crypto native.
That's exactly why it's significant.
Yeah.
Stripe entering this L1 race, that's like a 5-alarm fire for Circle and Tether.
Why?
Because of Stripe's existing scale, millions of merchants globally. Tempo is still in stealth mode apparently, but the focus seems clear. Build a super efficient, low-friction payment settlement network. And yes, EVM-compatible again.
But why build a whole L1? Stripe's a payments processor. Why not just use USDC or something on an existing chain, maybe an L2? Seems less risky.
Because Stripe fundamentally doesn't want to rely on anyone else's rails. Not Visa, not ACH, not Ethereum. They want total control over the entire payment stack.
End to end?
Exactly. They want the cheapest, fastest, most adaptable system for their massive global merchant base. They're not just trying to integrate with crypto payments. They're trying to become the default operating system for internet money, potentially leveraging their existing user base as a ready-made ecosystem.
That ambition is definitely visible in their recent acquisitions too, right? Bridge for $1.1 billion. That was stablecoin infrastructure. And Privy, the wallet developer.
Right. Those moves signal they're serious about building the full stack. Issuance, custody, settlement, everything. You're not just dipping a toe in. They're aiming to be the payment landscape for their users. That's the real strategic threat here.
Okay, let's try and bring this all together, this huge infrastructure battle. What's the core choice facing those big institutions, the banks, the asset managers, maybe watching this unfold?
I think it boils down to that core conflict. Compliance versus economics, really. Or maybe compliance versus speed and market dominance.
How so?
Well, EURC, Circle's offering, is the safety cushion. Full transparency, designed for MiCA, future U.S. rules. But that safety comes at a cost. High operational expenses, probably lower margins for Circle.
And stablechain?
Stablechain, Tether's L1, prioritizes market share.
Yeah.
They optimize for profitability using those higher yield, perhaps riskier assets. That lets them offer incredible speed and cost efficiency, like zero-fee PDP. But they accept more regulatory uncertainty.
It's like choosing between investing in a heavily regulated, secure utility
versus a faster-moving, highly profitable tech startup, maybe with some unanswered questions.
Yeah.
And we should mention the alternative, right? Not everyone has to build an L1 from scratch. Oh, absolutely. That's a crucial point. Building a dedicated L1 is a multi-year, potentially multi-billion-dollar gamble. Many institutions might just say no thanks.
And do what instead?
Opt for building an L2 solution. Build on top of an established public chain like Ethereum. You inherit its security, its liquidity, its network effects, but you can still customize for speed and potentially lower fees. It's a faster path to market, lower risk. A compromise strategy.
Right. So that choice, the L1 compliance fortress like EURC, the L1 speed demon like Stablechain, or maybe an L2 compromise, this is really critical for you, the listener, isn't it?
It really is. Because whoever wins this infrastructure war, their standards, whether it's deep compliance or pure cost efficiency, will likely shape the future rails of global digital payments, how capital markets operate. It's foundational stuff.
Infrastructure warfare, that's a good term for it. The stablecoin competition has escalated way beyond just tokens.
It's become a fight to build the very foundation of future finance.
Okay, so to leave everyone with a final thought, you mentioned Circle's CEO talked about EURC being for more than just people, for machines, systems, AI agents.
Yeah, that was a really interesting point he made. Secure, automated on-chain transactions specifically designed for autonomous systems.
So think about where that leads. If these dedicated L1s become the standard plumbing-compliant sub-second multi-currency.
How long before AI agents just start managing huge parts of corporate treasury, or even capital management, directly on these rails?
If an AI can execute complex multi-currency settlements instantly, compliantly, 247, what happens to the human roles doing that today?
The potential for automation, for plummeting operational costs in global finance, it could be massive, and maybe much closer than we think once this infrastructure is in place.
The financial AI revolution, maybe built on proprietary layer ones, definitely something to think about. Thanks for joining us for this deep dive.